What's going on, guys? Welcome back to the channel, and in today's video we're gonna be talking about stop losses. But before we get into it, make sure you hit that subscribe button, smash the like, and click that notification bell so you don't miss any of these great tutorials or urgent market updates that we'll be uploading to the channel. So what is a stop loss? A stop loss is essentially just an order that you set that's designed to cut your losses, right? Or limit your risk. So if you enter a trade and it starts not going your way, you have that level where if price comes down and hits it, it will exit you out of the trade for a small loss. Now you can set these levels anywhere you want. Obviously there's some methods to the madness. What a lot of people do is they'll just pick a random number, right? They'll pick, I don't want to lose 5%. I'm only willing to lose 5%. So that's where they set their stop loss. And you don't want to do this, right? And the reason being is that the chart doesn't care how much you're okay losing, right? It's not going to interact with that level at all. There's really no logic behind there other than you're just trying to save your loss. But what you really want to do is you want to find the level where your trade idea is invalidated, right? So if you're trading based off of a pattern, you're going to want to find the level that invalidates that pattern, right? So if you're waiting for a breakout out of a specific pattern and you break down instead of breaking up, then you might want to set your stop loss below, a little bit below that breakout point, so when your pattern gets invalidated, it comes down, hits your stop loss, and cuts your losses. So why are stop losses so important? Now, number one, this can completely save you from getting wrecked, right? You can't get liquidated if you have a stop loss. Number two, it can totally take out emotion from trading, right? So you can see the estimated amount of money that you're going to lose when you set your stop loss, right? So in theory, you should be able to set your stop loss, be okay with that number. If the trade does not go in your direction, you should be okay with that number and be able to set your stop loss, set your take profit, enter the trade, and walk away. You shouldn't have to be checking your phone every 5 minutes. That means that you probably have your stop loss too low or you're trading with too much money. But by setting your stop loss, you can have that safety net and you can walk away. You don't have to have your face buried in the charts constantly. And if it hits your stop loss, you take a small loss. You were already okay losing that amount of money and you'll get them next time. Don't worry, you're inevitably gonna lose some of your trades. So without further ado, let's jump into the charts. I'm gonna show you guys 3 different methods on how you can set your stop loss. One for more of a risk-averse person who doesn't really wanna risk a lot of money on a trade. A second method that is a little more risky, right? You might lose a little more, but you do have a little more room to play, but it does give your trade a little more wiggle room, right? So you're not consistently just getting stopped out as soon as price goes a little bit in the opposite direction. And then we're gonna cover one last method that allows you to limit your risk while also giving your trade enough wiggle room to breathe, again, so you're not just getting continuously stopped out. So let's jump into the charts. I'm gonna show you these 3 examples and kind of break down the thought process behind them. Let's get into it. So we're here on the Bitcoin 4-hour chart, and just for example, I'm not saying these are good trade setups. I'm just trying to find spots where I can show you guys where to set your stop losses. Now, let's say you're looking at Bitcoin here on the 4-hour and you see that we're holding this level generally as support. And let's say you see that you are holding this level as support. And let's say, just for example, you wanted to enter a trade based off of the bounce off of this support. Again, not saying it's a good trade. I'm just giving you guys an example. So in this case, you're looking at this area right here for a bounce and you want to enter your trade there, right? We'll just mark it with this little dot. So now where would you set your stop loss in this case, right? So for our first method, we're gonna talk about the more risk-averse method, right? And that's where you would set your stop loss right below support, right? So for this case, you might not want to set it too close, right? Because then the second any wick comes down, you're going to get stopped out immediately. And you don't really want to do that. Although you could do that if you don't want to risk a lot of money and you're okay having more red trades than green trades, as long as your red trades are much smaller than your few green trades, right? So you might not want to go right up against it because you'll get stopped out really quickly. So you might want to just come down just a little bit and maybe set it right there. Now, this is a tight stop loss, you're only risking about 1%. But if you get stopped out, it's going to be a very small loss. So you're not really risking that much. And if you're very confident in the trade, then, you might just be like, you know what, if this goes a tiny bit below the support line, I'm out. I think this is definitely going up. If it breaks the support at all, I'm out. Now let's find another example. So for this example, let's look at a short. So let's say you're looking here. We are on the Bitcoin 15-minute chart. Now let's see, you came up, right? Then you came down and you started kind of playing in this, this little range right here. You came out and then you came back down, you bounced around a little bit, right? So let's say you saw us come up, you bounced off resistance, came back down, and then you saw that you were coming up to this resistance again, right? So let's say, just for example, you wanted to put a short in here off of the resistance, just keeping it really simple, and you want to enter a short, meaning that you want the price to go down. Now, where would you set your stop loss in this case? So in this case, because you're shorting, you just want to do the exact opposite of the last example, right? You want to set your stop loss above your resistance point, right? So we're going to pretend that none of this other price action is here, and all we see is this candle touching right here. So maybe you want to put it, right above the wick, right? You might want to put it right above there in case you wick back up there. And let's measure it out. Here is, we're on the 15-minute chart, lower time frame, so it's only a 0.6% stop loss, right? So very, very, very small loss if you get hit, right? But chances of you wicking up there are probably, decently high, right? Because you have to remember, price action is actually very messy, right? You see these diagrams of trading patterns and everything, and it's always a line bouncing perfectly off of a line. That's why we draw our areas of support and resistance as a range and not a line, because you have to account for these wicks, right? Support and resistance is usually an area, not just a strict line, and you want to avoid getting faked out when you wick past lines and then just continue in the same range. So you do want to give yourself just a little bit of room to breathe in case you do wick up a little bit, right? And then obviously this came down, and then you would have been in the green here, but then you came back up and then you got stopped out, right? Because we hit our stop loss. So you took a 0.6% loss, no big deal, you'll get it next time. So that is the more conservative, risk-averse method that you can use. A lot of people do that, setting it right below the support line or right above the resistance line, whether you're longing or shorting. Very, very safe way to trade. Now, most likely you're gonna lose a lot more of your trades, but like I said, as long as your losses are smaller on the red trades than your gains are on the green trades, then you should be in good shape, right? Your account might look something like small loss, small loss, small loss, small loss, big win, small loss, small loss, small loss, big win, right? So as long as your big wins outweigh your small losses, you should be profitable, and really that's all that matters. Now, our next method is actually a little more risky, right? Your stop loss is gonna be a little farther away and you might take a little bit bigger of a loss, but you have a less likely chance of getting stopped out because you have that little extra wiggle room. So now we're looking at XRP on the 15-minute chart, right? And you notice you're on this downtrend here, and let's say you're seeing that it is respecting this line a few times, right? And you come up here and you wanna take a short, right? So let's say right here is where you want to enter, hoping the price goes down. So now for this method, what you want to do is you want to set your stop loss above the last swing high, right? But if you're longing, you want to set it below the last swing low. So right here, this would be the last swing high technically. So, you could set it here, maybe go to the top of this wick, right? And, assuming maybe you got in on like this red candle right here, let's go ahead and let's actually move this line down to our entry, and let's go ahead and measure it out. So about 1% or 1.3% stop loss, still not too risky. We are on the 15-minute chart here. You will realize, if you remember on the last example I gave you guys on the 15-minute chart with the last method, it was less than 1% stop loss, right? It was about 0.6%. Now this gives you that extra little breathing room, and if you wanted to have a little more breathing room, what you could do is you could just bring it above the last swing high, which would be right here, and that would give you about 2.4, right? So still a pretty small stop loss. However, if you do break above this line or wick above this line temporarily, you won't get stopped out right away. You get to stay in the trade, and then look at that, you wound up coming back in here and coming down. So that would have been a winning trade even if you came up to wick, even if you wicked up out of here quite a bit. So you do get that extra little wiggle room, right? You're not as tight, and it will keep you in your trades longer, but obviously if it goes the wrong way and you do get stopped out, you'll lose more money. So let's find a long example of this. And right here, you can see we had this level acting as resistance, right? And then we flipped it into support. You had one bounce, come down for the second bounce. Let's say you wanted to go long right here. Now, where would you set your stop loss in this scenario, right? So we are longing. So for this method, you would set your stop loss below the last swing low, right? Now, technically, this is your last swing low, but obviously that is right on our support line. We just wicked down a bit further than right here. So I would put it below this swing low right here, right? So you go a little bit below it. And now let's measure it out and see what our risk would be there, right? So 3.4%, so a little higher of a risk, but if we were to, break down and play around like this a little bit, you do have that breathing room in case you come back up and go higher. So that's kind of the idea behind this, right? And, if you're below the last swing low, if you're finding support at these levels, there is a chance that you could come down there and bounce off of it before you come past and get stopped out, right? So the idea here would be that, you might find some support at this level. That's why you go a little bit below it and you get a little more wiggle room. So that's kind of the thought process behind this method. Now let's move on to our third method. So now we're on the Ethereum 15-minute chart, right? And let's say you see us break this level, we come down, we start bouncing around on this level a couple times, right? And then let's say, you find something like, you find something on Market Cipher B, maybe it's a bullish divergence, and it's making you want to go long, right? So you have the low, the lower low, and then you have the low and the higher low on Market Cipher B, and you see a bullish divergence and you want to get into a trade right here. And where would you set your stop loss using this third method? Now, with this third method, basically what you want to do is you want to set multiple stop losses, right? So for example, let's say you want to set 3 different stop losses, right? So what you could do is you can, you would set your stop loss below the last swing low. Obviously, the lower one would be right about here. So we'll go a little bit below this wick, right? And then, your next one could be maybe, right here. And then you can set a third one below here, right? So now let's measure this out, right? From your entry to the first one is about 1.3%. And then your next one is about 2%. And then your third one is about 2.3%, right? So 2 and 2 is 4, 5, about 5% overall. But basically the thought process behind this method of setting your stop loss is that you could split your trade up into 3 parts. So you could take a third of it out at this level, right? If you break that. So now you're saving your loss, right? You're closing out a third of your position, right? So you're saving there, and then you have more room to play, right? So let's say this didn't go your way and you came down, right? You bounced around, boom, you took out a third of your position. So you saved a little bit, but you're still in the trade, right? In case it goes back the other way, you're still in the trade. If you truly think that there's a strong move coming, but you think there might be volatility on the way, this is a decent strategy. So let's say you come down, right? And then boom, you hit your second stop loss. Another third of your trade is cut, right? So your cutting losses there. And then, maybe you don't come down to this one and you wind up having that huge move you've been waiting for. And you're gonna be happy that you had these 3 stop losses because you saved some of your loss, and then you wound up, it obviously a smaller amount of money still in the trade, but you're still in the trade. So if you wind up having that big move you're looking for, you still get the gains, right? So now let's find a short example. So if you look right here, we're still on the 15-minute for ETH, and you see we're in a downtrend here. We bounced off again, and now we're coming to bounce off again. So let's say you want to take a short right here. Now, basically, where you would want to set your stop losses in this scenario, if you want to enter right there, is you can set it, above the last swing high, which would be, right about there. You can go above the wicks or in the middle of the wicks or to the bodies. It's totally up to you, depending on, like I said, depending on your risk tolerance. But, I would give it a little room to breathe, maybe put one there. And then you can put another one here above this swing high. And then maybe your third one comes right above this swing high, right? So price, you're shorting here, hoping that price goes down, which obviously it did. But, if you happen to break out the wrong way, at this point, you've broken this downtrend, basically invalidating your original trade idea, right? not to say that you can't wick out and come back in, but let's say you've been closing above this line and it is broken, right? You might get stopped out at your first stop loss, take out a third of the trade, and then you might come up and may or may not hit your last three, but I think you guys get the idea. You want to ladder your stop losses. That way you're protecting yourself, but also giving your trade room to breathe, right? The farther it goes in the opposite direction that you want it to go, the more money you're cutting and saving. So guys, I think that's all I have for this one. Pretty quick video. I just wanted to give you guys a basic idea of where you should be setting stop losses. Now, there's a million different methods out there. Everyone has a different experience. Some people are more risk averse. Some people are more risky, right? Some people don't use stop losses at all, which I never recommend, right? You can't get liquidated if you set a stop loss. In my opinion, the important thing is that you have a stop loss, right? Even if you set your stop loss a few dollars above your liquidation price, it's gonna be much better than getting completely liquidated. So just keep that in mind. So just to recap, we have three methods, right? The first one, setting it right below or above support or resistance, depending on if you're longing or shorting, right? If you're shorting, you wanna set your stop loss right above resistance. If you're longing, you wanna set your stop loss right below your support, right? And you might wanna give it a little room to breathe. You don't wanna put it right up there because you're gonna consistently get stopped out, even if the trade's gonna go your way. So just make sure you give yourself a little breathing room just in case you get wicked down. But again, depending on your risk tolerance. Method 2, right? Setting it above or below the last swing high or swing low, right? Giving you a little bit more room to play depending on how price action has been, right? Some of them can get pretty close, as you saw in one of our examples. But if it's too tight, you could always set it above the next swing high or below the next swing low to give yourself a little more breathing room. And that's good because you won't continuously get stopped out. And our third method, setting multiple stop losses, giving you a good amount of room to breathe while also cutting your losses on the way down. So guys, if you're trading, make sure you're setting your stop losses. If you didn't know where to set them before, take any one of these methods and put them to use. It's gonna be dependent on what price action is doing, right? If your swing high, if you're shorting and your swing high is very close to, the area that you entered, you might want to go above the last swing high before that. And just to give yourself a little more breathing room. And yeah, just get in there, set your stop losses, try each of them out, right? Maybe you don't like getting stopped out constantly and you want to give yourself a little more breathing room, but then you try one method and you lost too much. You realize you didn't like that. You're a little more risk averse than you thought. And then you find the happy medium, right? So I just wanted to, put the bug in your ear, and just show you guys a couple methods on how you can set your stop losses. But like I said, it's going to be different between person to person, depending on your trading style, your plan, and all that stuff. But number one thing is, guys, it is very important to have your stop losses set. You do not want to get liquidated. And remember, you don't just want to pick a random number like 5% and set it. Sure, you're going to be managing your risk, but it's not, like I said, the chart doesn't know about that number or care about how much you're willing to lose. That's why you want to set it above swing highs or below swing lows, so you could possibly find some support right there, and it might save you right before you get stopped out. So hit the charts, get into a trade, set your stop loss, and stop getting wrecked. With that being said, I think that's all I got. I'll see you guys in the next one. Frankie Candles out.
Here we go, at the top of the class on a roll, and it's time to run it up, yeah, maxed out, put the pedal to the floor, ayy, on the road, here we go, yeah, we winning by a landslide, never see me coming, I'm a landmine, yeah, I ain't taking orders in command line.